So yeah, put in the chat which model or spreadsheet if you make your own or what, so that I can see what y'all use. And MFM model mostly. Michael Blanc. Okay. So one thing that I've learned, and Angel likes to say she pimped me out whenever I help people with their underwriting, and that allowed me to get just about every model out there that I could find or think of. So I have like Michael Blanc's, MFM's, Rod Leafs, Rob Beardsley's, Joe Fairless. Let's see, who else do I have? Um,
You got the Sumrock model.
Sumrock, Synthesizer. So I have a bunch of them. And what I ended up doing is I've tried to use them and I couldn't figure out anything that worked for me. It's like something would get me like 70% of the way there. It was like, well, what if it did this? Or what if I need this, or I need these kind of loan terms. And so what I ended up doing is creating my own model. And so I took what I liked about all of their models and I threw away everything else and then I improved upon it. And then now it just sort of evolves. It's a continuous evolution. I'm always making changes to it, especially in today's market where there's so many different lending options and creative financing going on, because that's pretty much the only way to get deals right now. So, Michael Blanc, you can't do a whole lot with financing other than say like LTV and whatever percent, and I think it has an interest only period. I don't remember right offhand, but it doesn't do seller carryback. It doesn't do any refinances. And so what I did is I took all that and added it to it. So in my model, we can just pretty much start from, I guess we'll start from how I create my model and let you go from there. And I'll show you. So for my model to work, I get a rent roll. I put it straight into my model and a T12. I add all the color coding so I can see what happens with it. And so I color code it so that you can see what the trends are going for a T12. So you can see if it's all green, everything gets better for the T12. And then I annualize a T6, T3, and a T1. So I can see how it's performing throughout the last year, if it's getting better and better as time progresses, or if it's dropping, or if it's falling. So here, this one, which one is this? This one is vacancy has been getting worse and worse over the year. And so that tells a story. It's not necessarily a good story or a bad story, but at least it's a story that you can work with whenever you start developing your business plan for this property. And it gives you some insight into what it's doing, why it's doing it, and how you can start mitigating it or improving upon it. So then you can see, well, yeah, vacancy is dropping or increasing. Um, but for some reason we are getting more rental income. So I guess that the market rents, they're increasing just so that they can basically overcome their vacancy issues, which that tells a story itself, because that you can only do that to a point, and then vacancy is going to take over and kill everything, and your vacancy is going to skyrocket if your rents are too high. But that's an asset management issue, not really an underwriting issue. But you sort of have to think about asset management and what you're going to do whenever you run all your numbers. Down here, same with the expenses. You can see if the red, the expenses get higher. If the green, the expenses get lower. So ideally, I want to see everything green. If the color codedness doesn't really work for you, I add in these little spark lines, which is little graph of what it's been doing over the last the over the T6 or the T12, T6, and T3. And so you can see, all right, the payroll has been going up and up and up, and then it sort of kind of just like goes through the roof at the end. Um, but let's see, you can see some other ones. Safety, that's not a good one. Let's see. Um, just repairs and maintenance in general. You can see that it started up high and it dropped off. So in this case, you're sitting at like 90, 100,000, and then it drops to 45,000. So then that makes you wonder, is like, what are they doing? Are they not doing something? Are they just trying to get it on the market and sold? Is that why they're not doing any more repairs and maintenances? So there could be some deferred maintenance whenever you take it over. So, and then you can see like overall expenses have been increasing and the NOI has been decreasing. So I
You
do this. Go on.
are you manually color coding this, or does your tool does it have it through some the equations that you put in of whenever it sees an increase, it flags it and makes it red or green? What's that look
I,
like?
I I use conditional formatting, so I try not to do anything manually in this. Typically, the only manual operation is formatting the T12 and the rent roll, just so I can import everything automatically. So yeah, it does this automatically for you.
Nice.
The spark lines are also created. I've also had spark lines for like over the T12, but for some reason they're missing in this case. They're usually like in column P, but for the most part, I look at the T12, 6, 3, and 1. Sometimes I'll look at a T9 just to get a little bit of a bigger picture, but yeah, this is like the very first step of what I do whenever I'm starting to underwrite. And for the rent roll, sometimes I have to go in and format. If you get a PDF of this, I have to convert it to Excel, which can really mess up the formatting, but that's, like I said, the only manual thing I do. Um, let's see. And then once I get the rent roll in a good format, I get the T12 in a good format. And also, if you look at the right hand or the left hand column, column A, you can see these buckets that I put everything in: payroll, general admin. I That is a manual process, but I'm working on automating that as well. Marketing, general contractor, repairs and maintenance, all that, so that whenever I come to my revenue and expenses tab, everything is populated for me, so that I have my unit type here. I have number of units of each type, so I don't have to go through it and count each one and figure out what the square footage is for each one, and then figure out what the current average market rent or the current average rent is for each one versus the market rent. And this market rent on a rent roll is not what like your market in the surrounding area where your neighbors are renting at the same amount. This is a market rent that new leases are leased at. So that's what property managers call market rent. So it may or may not actually be the market, quote unquote, market rent. And so I have current leases, new leases, and then pro forma. And pro forma comps, this is where you're looking, comparing it to your neighbors or what you think you can get from your rent. So this is where you fill this out. These two are filled out automatically. This one is going to require some manual effort just because it's not taken from anything per se, unless you're doing like a blanket $25 or something like that. Then you can add that in. But yeah, all of this done automatically. I've done. It can handle anywhere from like 3, 4 units. So it does do residential multi all the way up to I've done over 1,200, 1,400 units, 20 different floor plans. If I have more floor plans, I can always just add another unit type and it'll just drop everything down, keep all the formatting and everything correct so that nothing is really shifted in this whole spreadsheet. Um, And then from the T12, this is where we populate our other income, our losses, and then our expenses. So that's where these buckets come in. So I have the payroll bucket. Let me zoom in so y'all can see. If y'all can't see my screen, let me know. So payroll, general admin, marketing, advertising. So that's where all of these come in. So that's how I populate all of this stuff. And then for the year one, you can either go based off of this with some maybe whatever your annual growth rate is for expenses or revenue, or you can put them in manually. Usually I'll do the annual expense growth if I don't have any values right offhand, but generally I want to use my property manager's numbers for these. So my property manager's already looking at this project and they're going to give me a budget to use. So with that budget, I'll put all of this stuff in, and so that I know I'm going to be using the numbers that I would be using if I took over and actually bought the property. So now this is what looks scary, but probably is least used is this. You can do growth rates for each individual expense base or and you can change it for each year. Um, So like I said, I have like a big model. This is my big flagship model. It's called the Ironclad model. I have a more streamlined model, which is the Frigate, which is basically the same thing. It does about 90% of it, but it doesn't have all of the bells and whistles. So there's a lot of, yeah, you can adjust your expense growth rate at 4%, but that adjusts for everything. That's not, you can't adjust it based on the year. So if one model looks overwhelming, I have a more simplified model for you to use. So any questions so far?
So one question, Jason. So, and thanks for sharing all this. Learning things already. Why would you pick one over the other when underwriting a property? What would be the motivation in that?
On a model?
Yeah.
Um, so for me, if you go over to the summary tab in the waterfall structure, I have preferred equity. I have a class A, B, and C. If I'm just going to go in with just a single investor class, I probably am going to use this. If
Okay.
I'm not going to be doing um like a construction loan or I have mezz debt or junior debt, I might use I'll use the other one. Um so there are just some smaller features. If I do need one of the features that is available in this model, I'll use it. But like I said, the other one does 90% of it.
Got it.
One
Thank you.
thing also I'll use is if you get a loan that's LTC and you're going to be taking draws on it, you don't want some banks still charge you interest on the whole amount from day one. Some banks will charge you interest whenever you take draws for the capex part of it. I know people who've been in both, and I mean, ideally, you want to be in the one that will charge interest for you whenever you take the money, not charge interest on money that you haven't taken yet. But in this model, the big model, you can model it based on I'm going to take the interest on the draw only instead of the whole amount. So that gives another option here as well versus the Frigate, which doesn't give that option. The Frigate just assumes worst case you're paying interest on the whole amount for LTC. Let's see what others. For the most part, those are the biggest difference. If you have an adjustable rate, you're going to use the big model. The big model will do adjustable rate mortgages. If you're just doing fixed rate, and you're not needing these other things, then I would do the Frigate. They both run pretty fast. It's dependent on your computer, of course. I have macros running in the background. Um, so with the Frigate and the Ironclad, they're pretty much same computational time wise, but just like overwhelming your person. That's why you might want to use the frigate. Everything the frigate can do, the ironclad can do. So if you are going to do LTV, you're not going to do any of this stuff. You only have one investor class. You can do everything in the ironclad. You just turn these features on and off. So the frigate is just basically less overwhelming. Let's see. So that was the expenses of revenue. And like I said, everything is done programmatically, so you don't have to do anything by hand. I know when I first started out, I was looking at some big properties just to get practice, looking at 400 units, and I started doing is like, all right, this has 20 different floor plans, and there's no way I'm going to go through 400 units to try to figure all this stuff out. I'm going to have it do something programmatically. So that's why I did it. Um, oh, does a frigate does not do rubs. Actually, it does do rubs. Never mind, I take that back. So I can do rubs also in both my models. It can do existing rubs. If it's already doing rubs, it'll calculate what percentage is spilling back and everything. Or if it's not doing rubs and you're going to start doing rubs, you can't just like say from day one, you're going to start billing back 40% of the water bill. You have to increase it over time because I mean, everybody signed a lease and they're contractually bound for that time period. So then you have to wait until leases are up before you can start implementing it. And so this allows you to start saying, all right, we're going to start billing back water. It broke because there's no water bill in this case here. There's no utilities there. And then you're going to say, well, I'm going to start doing it from month 2 to month 18. That should encompass everybody. And then so it's going to ramp up to be fully rubbed out by the month 18. So that's another thing. So when I do see rubs and models, I never have seen a ramp up like this. And so it's like, bam, you're starting day one doing billing back 40%. And that's one, not reasonable. And two, just modeling it wrong if you think you can do that. So
I do like how your tool has a different debt options that you were showing. I've looked at various templates, and some of them you can do a case by case where, hey, we're going to do an assumable loan. You do the whole underwriting. You have to save it, start a new one to show, okay, we're going to do traditional or new agency. So I like how you have it side by side. That's a nice feature.
So yeah, let's get to the summary page. So the loan, this allows you to do all of these loans at once. If you're going to try different loan options, say you're doing a bridge loan, you're going to do agency or bank or an assumption, you may have to create different models for it. But if you're doing, say, and let's look at the frigate, if you're doing primary mortgage, and then you're going to do maybe 30% seller carryback, so they're going to cover part of the down payment, you can include that here. And then you can say, all right, well, we're going to refinance in whatever month. So each of these models does refi. But if you're going to do like agency here, and then you want to compare it to bridge, you will have to do it because agency and bridge are going to be both senior acquisition loans. So that's why you'd have to do different models for it. I do in my Ironclad have the scenarios where you can run different scenarios. You can run different purchase prices, hold periods, refinances. Every variable that I create in my model, I name. And so you can change any variable you want and see what it does. Unfortunately, right now, you can only change one variable at a time. So with that, you can say, I will changing from bridge to agency, you're going to be changing your interest rate, 2 your term, 3 your interest only period. So it's hard to do a scenario for bridge to agency in this model, but I'm actually in the works of fixing that and going away from Excel and doing web-based where we can do a lot more flexibility. That is in the works. And we're projecting maybe 6 to 12 months before we start getting it out for beta testing. So let's see. So yeah, with the current market, there's a lot of seller carryback options. That's why I wanted to include this and the frigate versus just having a single loan and then a single refi. This is a 10-year model, so I can only go up to 10 years. Generally speaking, for apartment syndications, you're looking at a 3 to 7 year hold. And so with a 10-year model, I only put in a single refinance. I do have some retail models that go out 20 years that allow for 3 different refinances. So the longer you're going to hold it, the more likely you are to refi it. But in this case, um, like I said, for 90% of the cases, you're looking at a 3 to 7 year hold, and that only gives you time for maybe one refi, two possibly, but generally speaking, that's one. So if you're refinancing twice, either you're building up equity like a madman, or you didn't refi into permanent debt the first time. So, and and that could be possible, especially with the way interest rates are. I mean, they are coming down, but they aren't down like they were a few years ago. So, um, so yeah, that's the lending stuff. As I said, the Ironclad one does handle variable rates. I come in here, I can copy and paste the forward curves for the software and the 10-year treasury. And this is what it uses. This is also what it uses for, where is it? If you have different prepayment penalties, you can do step down for agency, or you can do yield maintenance. Now, granted, yield maintenance is just a best guess because you don't really know what's going on with interest rates. Yield maintenance, if y'all aren't familiar with that, it's basically investors invest in the lender. So they'll invest their money and they're going to get, say, 6.5% for 5 years or 10 years or whatever. So if you pay back that debt early, the lender then has an obligation to its investors saying, hey, we know we promised you such and such percent for 5 years. Unfortunately, they paid us back early and now it's coming back in 3 years. So that's why you get a prepayment penalty. With yield maintenance, it depends on the direction of interest rates. So with interest rates going down, yield maintenance is going to go up because they're taking their money out of a higher interest rate investment and putting it into a lower interest rate investment because all the interest rates have dropped in 3 years. So your prepayment penalty is going to go up for that. But if your interest rates are climbing, all the investors will be like, yeah, take it out of that investment in 3 years and put it into a different one because interest rates are higher than that. So that's why yield maintenance has an inverse relationship with the direction of the um, interest rates, and it's hard to predict what's going to happen in the future. I mean, you have these forward curves, but what do these actually mean? So any questions so far?
Part of me is joking, but also serious. Is I'd love to hear more about this deal.
Th-
Offline, the returns look great.
Oh, this deal is just a generic deal. I don't even um Oh, another thing about my model is you can only have one open at a time, and I have two open. So since it's running the macros, I think it gets confused on which instance it's running in the macro area. And so that's why one has 55% IRR and the other is not showing anything. It's because I think it's getting confused. And let me close this one down. Don't save.
You're breaking Excel again.
Yeah, this is another reason why I want to do a web-based version is because I do want to be able to compare side by side without breaking stuff. But see, I have this little yellow button here that goes in and allows me to click it and recalculate everything. So it basically resets. So there's some stuff going on in the chat that I'm not paying attention to. Another thing that I hated about just about everybody's model is, yeah, you get cash flow or pro forma numbers for the year. It's like, yeah, that looks good. Let's see if this is a good model to show. No, this one's too high. But I have it broken down by the month so you can see what you can expect for each month. This allows you to go in and follow your business plan a little bit more closely versus waiting until month 13 and realizing your NOI is 300,000 off and you don't know why. You can start seeing that from the get-go. And another reason why I like having the month is there's a lot of deals, especially with heavy value add, where you might have, like I said, this is a big deal. You might have like 18,000, 1,800 for year one, something small but still positive. And you're looking at it and you realize the first 6 months you're going out of pocket on. So you either have to have the reserves or you have to somehow figure out how you're going to pay for everything for the first 6 months. But then in the latter half of the year, after you've done your renovations and you've leased everything up, then you make up your negative and you get positive up to that 18,000. So I've seen that numerous times. And so, yeah, you might see like 18,000 here, 36,000, 100 and whatever thousand. But it's like, oh, we're going to be black from day one. It's like, no, you're going to be going dipping down negative, and then you're going to be going back up. Every time there's negative cash flow after debt service, that means you have to come up with cash, whether it's temporary or not, because I mean, debt service is debt service. They have to get paid. Otherwise, they're taking it over before you even take it off the ground. So that's one reason why I like the monthly. Um, let's see what else is there. Oh, I said this is a 10-month or 10-year hold, but I have 11 years on this. Why do I do that? This is so I can do projections out another 12 months after 10 years so that I can say, all right, my NOI is this on year 10, but it's still projected to do this at year 11 so that you can run different numbers like your sales numbers, what you can expect to be able to sell it for and stuff like that. So even though it goes out to 11, this is still just a 10-year model, if that confused anybody. Let's see. Another thing, I showed y'all some of the scenarios you can do, but there's also sensitivity analyses you can do. You can do different exit rate caps. You can do interest rates. So if you're still in if you're still in the lending hunting phase where you're trying to get the best lending options, you can put in different interest rates here, or you can use this for your adjustable rate. Well, what happens if the rate goes up to this whenever we have it? So that's what you can do with the sensitivity study on the interest rates. And then you can also do some like on exit cap rate versus rent growth. Like, well, what if you don't think you get the right rent growth, but the exit cap is really good? So then you get some numbers here, and then it just runs everything. If y'all ever used Rob Beardsley's model, he does all this in data tables. And if you have this little box checked up here, the autosave, you can't really do anything because it's constantly saving, constantly running, and that bogs your computer down. So what I ended up doing is, so you see my cursor here. Let's see if I can, it doesn't get bigger when I zoom in. You see the plus sign, it turns into a hand. There's a button there, and that'll run it so that I can do it on demand. It does take a long time because it goes through each iteration for each cap rate for each rent growth. And so you can click this even with a powerful computer and go make a sandwich, drink a cup of coffee, and then you can come back and then it might be done. So I haven't seen this feature in any other models I've seen, and I use this one quite often. So also, if you don't want to look at rate cap and rent growth, you can do a drop down and you can select any other variable you want. And it's two-dimensional, so you can pick two different ones. But if you pick the same one and the same one, it usually gives you an error. The column variable must be different than the row variable. So that's just to keep you honest whenever you're doing this. So let's go back to, is it rent growth? I'm not going to click it now because it will take forever and bog my machine down. Well, monthly KPIs. This is a big one, especially for asset management. This is in my course, I do 3 different phases. The first phase is like hunting and gathering, finding the information. The second phase is putting it into the model. And then the third phase is using the model as your business plan. So here we can actually, it pulls your pro forma. You can import or put in your budget that your property management has, and then you can compare it to the actuals. So this is going to be like done on a monthly basis. We're like, all right, we closed in April, so our first month is May. This is what the budget is. That one can be put in annually because you get a budget every year from your property management. But then as May happens, you get their financials, you can put it in, you can start seeing how it's performing based on 1, your budget, and 2, your pro forma. And then you can, I've created this, I've broken it down into every expense like utilities, I've payroll, so I can see where we're going off track and how we can get it back so that we can get the investors the projected returns like we wanted or like we told them we would try to get them. So a lot of times I've met people, they never open their underwriting after they submit an LOI. Sometimes they'll do it after due diligence. They'll update it with their CapEx budget from they discovered through due diligence, but then they never open it again up after closing. So what I teach my students is this is a living, breathing document. This needs to be brought up at least once a month with your asset management team so you can see where the numbers are and where they're going. Because if you don't know where you're going, you don't have an idea where you are, you can't make any direction. So this is just good business practice, especially if you have investors. And I mentioned before, I had like 3 phases for my underwriting course. The first phase is the hunting and gathering. You can have the best model in the world. I'm not saying that this one is it, but if you have the best model in the world, if you're going to put garbage in, you're going to get garbage out. And so that's how I teach them how to minimize the garbage going in. And then I give them a model that will allow them to do all the flexibility they need. So any questions or anything on that? No? Anything anybody want to see or questions on anything? This model also does GP splits. This one, I think, confuses a lot of people. It's like, well, I have a team together. Now what do I do? How do I figure out what percentage you do? One, if you want to do it based on their role, then you can fill this out. Or you can say, well, I want to be a 20% partner. And what are you going to do for that? It's like, well, I'll do this, this, and this. Like, all right, if everybody agrees, it's okay. But if you want to say, all right, well, I only want to do underwriting and I'll do the due diligence stuff. I want to do everything to acquire the property, but I don't want to do any asset managing. So then that's where you can start filling this stuff out. Here I have capital raising. Now with capital raising, everybody knows or should know the SEC rules where you can't get compensated for capital raising. unless you're a dealer broker. So you're going to have another role, and those roles are outlined on this sheet. So a role could be, all right, you're using my balance sheet, you're using my liquidity, so that's what we call a KP. And so then that could be a role in itself. Yeah, I'll raise money and I'll be your KP. And that's all they're going to do. That is a good role. If you're going to do all your acquisition stuff, your underwriting, your due diligence, lining up all your third parties, that is a valid role. Putting down earnest money or the due diligence expenses, that
It's
is
11
a valid
o'clock.
role. Yes, it is. Um, Asset management, investor relation, that is a valid role. So you have to have these other roles if you're doing anything, but this allows you to figure out all the percentages, and you share it with your team so that everybody feels warm and fuzzy whenever they do it. So do we need to get out of here?
No, we still got 3.5 minutes left on here, so no worries. I just have Siri to remind me.
Okay. Partnerships. This will break down. This is where you get like your 100K investor. This is for your investors. Like say, all right, I'm putting 100K down. This is what you can expect whenever. So you can put in 100K investor here, or you can break it down into your like your A, B, and C, a GP team. So this is just a good projection of what the cash flow for each investor would be. You can do it individually, or you can do it like class A, B, and C and break it down based on like the total amount. I don't use this personally because I use portals for my investors and that takes care of all of this. But if you wanted to do it, you can. So what is more important is down here, you get to see what the GP makes based on your acquisition fee, asset management fee, and then your like your whole catch up your waterfall splits and stuff. This is where you get to see where you make your money as a GP. So I use the bottom part more than anything than this part, but I mean it gives you the flexibility to use it. I do put out a model usually every 3 to 4 months as I either find bugs or I add new features. And so I do have a change log here. I try to keep it updated, but it's obviously not. But I haven't released a new one lately. So I actually didn't go over the construction tab yet. Here you can break out all your exterior interior renovations. I've used this, I've sent this straight to lenders and they love it, especially when you itemize everything and they see your plan, they see you're going to start changing the pool out and month whatever. It all depends on when you are going to one close and when it makes sense to do a pool, because you want to do it in the warmer months but not before the pool season. And then it also breaks it down into the monthly stuff so you can see about how much you're going to be outlaying each month for it. And this also, if you are using the Ironclad model and you are doing your renovation or you're doing your draws, your interest rate on draws, this is where it takes into your schedule so you can figure out I'm not going to take out 60,000 until month 5 because that's going to be April when I can change the pool out or fix the pool. And so it'll say month 5, 50,000, and then that'll add the interest into the loan amount for the LTC or whatever. So that's how it's tied in together. And everything is based off of this closing date. So you do need to have a really good closing date here for all your CapEx and especially your KPIs so that you know when things are going to happen. So.
And Jason, if you can link, because we're heading into the time here to hop back out to the main breakout room, if you can put any contact information, how we can reach out, especially see further or ask questions about this Ironclad model, or even the mastermind that you're holding, that would be great. Perfect.
Yeah, I put in my ironcladunderwriting.com. I'll put in my link tree. This is allows you to get to me either like through LinkedIn, this follow us on Instagram, YouTube, all of the above. I am putting together more content on my Ironclad underwriting site for free so that y'all can gain access to some stuff. Of course, I'm going to use it as a lead gen, so you will have to give your email and stuff, but that just puts you on a list for a bi-monthly newsletter. So I don't spam you. I don't do anything like that. But if you are interested in signing up for my newsletter or want to reach out, you can definitely go through any of the links that are posted in the chat. So thank you, David, for putting my website up.
You actually beat me to it by seconds, so you know.
Well, we appreciate you, Jason. Definitely good to see other models. I mean, I feel like every different model I see, there's some different data point that is very crucial. And I think Angel hit on it the best in terms of extrapolating, what she put extrapolating for the year, max, low, or high months. And that's something you just get caught into seeing the year 1, year 2, year 3, and you don't really look farther into that. So that's a huge takeaway. So I appreciate that.